If everybody is screaming recession, that means they're not buying the assets. I can buy whatever I want at a cheap price. And anybody that has a job right now that can invest, millionaires will be made by buying things today. Millionaires.
Welcome everyone to another episode of the Jack Bosch Show, where we talk about all things real estate and finance. And today is the day where we're going to talk about finance. We're going to talk about microcaps. We're talking about the market, what the market's doing, the stupidity that we see on the market, and all those things around it. And our guest is microcap investor, expert, financial expert, Mariusz Skonieczny. Mariusz, I hope I didn't butcher your last name too much. It's a difficult name to pronounce in the American language or the English language, but welcome to the show.
Hey, thanks for having me. And you did pretty good on my name.
All right, good. Well, I imagine I changed my name from Joachim, which nobody in the US can pronounce, to Jack because of that same reason. And so I applaud you for actually keeping your name.
I just keep it for interviews. Like in real life, I just tell people to call me Mario.
Mario, okay, well, sounds good. Well, Mario works. So Mario, so let's go right into it and talk about what your expertise is. What do you specialize on in this world?
So I specialize in small, like you said, microcap companies, small companies. And why small companies? Well, because the financial industry calls it toxic. They call it penny stocks. They don't want to go near it. They say you're going to lose all your money in it. You're going to go broke. So that's great because then I don't have any competition, or I have very little competition. And
that's right. I
don't like competition.
Yes, well, I mean, what strikes me is that I never gotten much into microcaps, but what strikes me at it is that microcaps are companies like any other companies. They're valued between probably like $50 to $300 million typically, and they still have earnings, they still have growth trajectories, and so on. So why shouldn't you be able to invest in those? Because their stock moves just as other stocks. Probably a little bit more volatility, I would assume. But how do you deal with those with the volatility in that market? Or am I wrong that they don't have?
No. The volatility is absolutely insane. They have less liquidity, and they sold off really heavily during these times. But look, not all stocks are created equal, right? There's a ticker symbol and there's a company behind it. So you might have absolutely bad companies behind it, or there might be promising companies behind it. Don't make an assumption just because something is of a certain size, it's not good. Just because, or depending on what the stock price is not good, or whatever. You got to look behind. And I know you are into real estate investing, so I always like to use an example of, the financial industry will tell you don't go for these small companies, but then the same person giving you advice will tell you it's not a bad idea to buy apartments. Well, if you have a 100-unit apartment building, and if you put it in a public vehicle and it would become a publicly traded vehicle, guess what? It would be a microcap stock.
That's exactly right.
Because apartment buildings, what are they worth? 2 million, 5 million, 10 million, depending on where it is. But it's not worth, a 100-unit apartment building is not worth $10 billion. So it would be a microcap. So why is it okay to put your life saving into an apartment building through private ownership or syndicate or whatever, but it's not okay to buy companies of similar size or businesses of similar size when they're publicly traded? Doesn't make any sense.
That's a good question. I mean, we could dive into that. Like, one of the reasons I think people, and I'm not saying it's right or wrong, people say that it's okay to do one versus the other, is because if you buy the entire building, you are now the business operator and you have more control than if you buy a few shares of a company that is not big enough to make it perhaps through the hard times and so on. And also real estate is perceived to be more stable because rents are rent, and they're going down slowly and they're going up slowly. But overall, it's it's more stable, and it's something that people can like touch and so on, versus on over here, they're investing more passively. But I can totally see your point. At the end of the day, it's still, you put it into a public vehicle, it's still a micro stock. So that makes total sense.
And some businesses like real estate are more stable than others. You know, some businesses have better quality revenues, right? Yeah. Some have recurring revenues. Some don't have recurring revenues. So
let's go into that actually a little bit more. So how I want to also go into your background. You have an accent. I have an accent. We're both actually from neighboring countries. You're from Poland. I'm from Germany. Let's go first quickly into your past. Let's go. I want to quickly know. You're in the U.S. Where do you live right now?
I live in Indiana, like close to, you know where University of Notre Dame is?
I do, yes.
Yeah, so very close there.
Okay, did you go to Notre Dame and then stayed there, or you just happened to be going into that direction? And how did you get there? How did you come to the U.S.? Tell us a little bit about your story first.
Well, I came to the U.S. when I was 16, in 1996. Okay. When I was in Poland, I was an athlete. I was in a specialized track and field school. I was a sprinter. And during the 90s, and as everybody in Europe, we all played soccer. But then during the 90s, something special happened, right? Michael Jordan, Barcelona, 1992. So we all kind of started playing basketball during the time. So when I came to the US, I really, really wanted to play basketball, because we didn't have any clubs, basketball clubs in Poland. We had soccer clubs, but not basketball clubs. So when I came to the US, I did make the basketball team in my high school, but I didn't speak the language. I never played organized basketball. I never got the chance to play. Like, I was on the team, but I never got a chance to play. And so kind of I ended my athletic years when I came to the US. And I started dancing, actually. I became a ballroom dancer. And also to kind of, continue dancing, I was always looking for ways to make money that I would get a lot of return for the effort that I put in. And I realized that the best way to do it is to be in spaces that are not competitive. Like, if I wanted to make money being a basketball player or a soccer player, I have to put a lot of effort and I would get very little return. And that's what most people do. They want to do what everybody else does. They want to go and compete for the best schools, go get to the Ivy League schools, and then get those jobs, investment banking jobs and things like that. Well, so that's kind of how I got into that path of being in a microcap space, because I was looking for ways to make a lot of money putting little effort in comparison to the amount of effort that I would have to put in other places. And also I realized that there was very little competition. And also around that time, I discovered Warren Buffett, and I studied everything that he had to say. And even now, if you go back to some of the things that when he was asked a question, what he would do if he was a college student and had $10,000 to his name, he said that he would go into the most obscure places, which is small companies, because the investment industry cannot go there. So you can find and uncover things early. And that market is the most inefficient market. And that's where you can get most of your returns, if you choose properly. But instead, and
that's actually a good point. If I quickly jump in, like I read, I think we're very similar in that. I read almost everything that Warren Buffett wrote, or that was written about Warren Buffett, multiple of his books, his annual reports and things like that. So love Warren Buffett. So, and I agree now that obviously at this point, he can't do this anymore because he is sitting on $200 billion or something like that. But starting out, that makes sense. So in essence, I find it fascinating that really high school, and those things taught you to go for where the least competition is, where you basically can have the biggest impact with the smallest input. And that's really a criteria usually, or characteristics of a contrarian. So would you call yourself a contrarian?
Absolutely. It's my entire life I was a contrarian.
So am I. Yeah. So yeah, love it. So now you figured out the microcap space, and you mentioned Warren Buffett. So am I safe to say that well, the next question I wanted to ask you is, how do you select these microcap stocks? Do you do technical analysis, or you do fundamental analysis on those?
Well, of course, fundamental analysis.
Okay, I figured. I just wanted to make sure. Since Warren Buffett obviously comes into the picture here, it needs to be fundamental.
I mean, technical analysis doesn't really work that well for small companies, because the price movements could be completely out of whack. I mean, you can buy something at noon and be down 30% by the time you take a nap, because John from North Carolina decides to unload his entire position and he doesn't know how to sell.
Right.
So, I mean, the volatility in these names is crazy. And that's one of the reasons why even the institutions that would want to be in that space don't want to be in that space, because volatility is too great. And if you're running an investment business, as an advisor, it would destroy your business. If you have too much volatility, your clients could not handle this, and they would just leave you.
Yeah, that makes sense, because clients can't really tolerate that kind of stuff. So mentally, I mean, emotionally, they see themselves going up and down. They want to slow and steady. So how do you go about selecting what's your process to select a good company in there? What do you read? What do you go after? What do you request? What do you so if somebody says okay, that's a good idea, that sounds appealing to me, microstock, never thought about it, less competition, yes, high volatility, but if the key is to find the gems in the list of these properties in that market space. First of all, where they typically traded. Let's go there first.
Secondary exchanges usually. So, for example, Toronto Stock Exchange Venture, Canadian Stock Exchange, or OTC, which means over the counter in the US. US doesn't really have a venture exchange. That's why a lot of them trade in Canada. But the secondary exchanges that are not a NASDAQ or New York Stock Exchange.
Okay. And then how do you go and access those? Are there apps on there? Can you do that through your Fidelity account? Just give us a little bit, imagine there's somebody starting here and has never done it. And I mean, we have grown all kinds of businesses, but this is something that I have never done either. So if I want to go, and I'm fascinated by the deer, I'm a natural contrarian, I was great, let me go in there. What do I do first? I mean, where do I even, there's the secondary market. How do I find these markets? Are there apps that I can create an account on? How do I go about that?
I'll look at every company that's trading on that exchange.
So how do I find the exchange? I mean, it's a super simple.
So let's say you look at Canadian Stock Exchange.
So I grab my phone and I Google that, or
Canadian Stock Exchange, and it will show you all 800 companies that are listed there, and I will look at every one.
All right. Okay. Good.
I mean, the TSXV, which is the Toronto Stock Exchange Venture, will have 2,000 to 3,000 of them, and I'll look at all of them, and it might be oh my God, so many. Well, if you know what you're looking for, then you can eliminate a lot of them quickly, because the financial industry is correct when they're saying a lot of these companies are trash and shouldn't be touched. I agree. 80% of them are like that. So quickly you eliminate them, because 80% of them don't have any business. They don't have any revenues. They don't have any clients. They might be looking for gold and silver, right, in the mining space, or they might, they might not even have a business. So that's quickly gold and silver. No, thank you. I'm not interested. I'm looking for something real. I'm looking either for, a company that already has revenues. So then I know that somebody is already paying them to solve their problem. Okay. Or I'm looking for some some assets that solve a problem, and then they might that solution of the problem will bring revenues in the future. That's a little harder to do. So with the asset plays, I don't know, maybe someone told me, hey, look at this company, and I'll look at it and I would be surprised. So for example, right now I'm involved with a company right now called Aduro, which is a pre-revenue company, but what they have is a technology to recycle plastic. So they are able to use water to take plastic and to break it into molecules that came into making plastic. So they can take plastic, break it apart into molecules, and make plastic again. Or they can take and make fuel, because plastic is made from petroleum products. So they could take it and make more petroleum products. So that's an example of a company that somebody told me about, and I was screaming and crying for 2 weeks, meaning didn't want to look at it. And then after I made the trip and visited the company, did a lot of due diligence, I was like very impressed and decided to, take a position in a company like this. But it's a little harder to find something like this that says, we have something that's going to change the world. And, because every single one of them will say that they're going to change the world. Every single one of them has a cure for cancer, so it's like, and every single one of them, it has something that disruptive. And in reality, most of them, what they're going to do is disrupt your wallet, not the thing that they say that they're going to disrupt.
Yeah, no, that's true. Okay, so the process is look at them, eliminate certain kind of classifications that are like the treasure hunter kind of category of like gold and silver. Looking if they strike it rich, it could be good, but it's a gamble.
But it's kind of like if you were to look at residential real estate deals. Like if you look at 100, you're gonna find something that's interesting. Like there's really no formula. I mean, there's certain check boxes, but like real estate is more uniform. There's more standards, 3 bedrooms, whatever. But you look at enough opportunities, you're gonna be like, wow, that's interesting. Wow, they have something here.
No, I can totally see that. And particularly when you have companies that have revenue already, and you said you even go visit the companies in some cases. But then as you look into the financials, what are you looking at the actual financials? Since they're publicly traded, I would assume they have quarterly reports and things like that too. What are you looking in the financials for specifically? Like you're looking for revenue growth, profit growth, profits at all? Does it matter? What kind of alarm signals or positive signals that you look in there in the financials?
I want to understand what the business is about. So financials is just one thing to look at, but it's not everything, right? So I look at the financials like, okay, do they have revenues? Are they profitable? Do they have debt? What kind of margins do they have? Do they have recurring revenues or not recurring revenues? What is the addressable market? But then I always talk to the management. I know all of my management. Most of the CEOs that run these companies, I have their cell phone numbers. And you couldn't do that. You think I can talk to a CEO of Microsoft? Like, no, right? But the CEOs of these companies, they will pick up the phone and they will talk to you because not many people call them. And they are the ones that can teach you the business. But they can also lie to you. So you learn from them. But I also like to do what's called scuttlebutt investing, where I get on the phone and I try to talk to the people that are involved with this business, whether they're customers or suppliers, employees, former employees, to get a better understanding of what I'm dealing with. If this is something that, I want to get involved.
So what's your biggest loss that you have taken on any of those kind of investments? And then I'll ask about the biggest win in a second too.
Well, so over 13 years, I started with 10,000. By 2021, it was 7 million. And I'm probably down 5 million over the last 2 years. Okay. And you can say, well, is this a failure? One of my investments companies turned out to be what I would consider a failure because it failed my original thesis that I wanted it to happen. But just because a company is down, 50 or 70 or 80% doesn't mean it's a failure in this market when the market is completely insane. I mean, I have situations where the company today, it's better than what it was in 2021, and it's trading at 80% discount what it was, but the company is better. So I wouldn't call it a failure.
And what's your biggest win, particularly on a particular investment, let's say that you made, where you put in
100 times my money.
100 times the money. Okay. So that's what we're talking about. Of course, the ultimate failure is lose your money, but the upside is 100 times your money in some rare cases, right? But
it could be more. I just experienced myself, but I've seen many companies that, had even bigger opportunity. I mean, that's why you go into that space, is for those opportunities. You don't go there to double your money. You don't need to go to double your money. You can just
definitely don't go there to get a 10% return, right? You go. Right. Yeah. So it's not for the faint of heart, definitely. But I think it has definitely its place if somebody's willing to actually dig into the companies, dig into the numbers, dig into the business model, dig into the management, dig into all the pieces of it. And I've been fascinated. I love it because I have never been a big fan of technical analysis because of charts and things like that, because it's all theory in a way. If it hits this support and that support, it goes further and so on. Have always been a Warren Buffett fan of you look at the true quality of a business, and then you see if it's undervalued or overvalued, and occasionally you find an undervalued company like that you just mentioned, company that's better today than it was 2021, but it's down by 80%. Well, that would be a company that eventually, if it keeps going well, eventually the word's going to get out that it's doing well and it should recover. So that's really a deal that you should invest more. And other ones, well, you're not so sure. You pull back out of those, right?
Well, and also, if you think about technical analysis, it focuses so much on the short term.
Yeah.
And how much can a business change in 3 months?
Yeah. It doesn't. It's all speculation. Sure, it's all pure speculation. It's taking the momentum of this thing, the news from the Fed, the news from whatever. Elon Musk says something and it gets a stock bump, and versus what you're doing is the true, again, the value analysis and the value investing, compare like Warren Buffett invests for something, and this is a good business, this is a solid business. It's like Warren Buffett says, his preferred holding horizon is forever.
Yeah, and the 100x my money, it took 4 or 5 years.
Yeah.
Right. Yeah, because when you get involved in something, maybe an asset that needs to be monetized, or maybe a business needs to grow and turn profitable and get more clients. Well, if you've ever been in business, you know that it takes time to get clients. So it takes time to get things. But, today everybody just wants everything today. Right?
Absolutely. And that's the world we live. Now, you mentioned earlier something that says the market is insane. Please talk to us a little bit about that. What do you mean by that?
Well, do you know that we're going into recession right now?
Yes, it's the weirdest recession that we've ever seen. But yes.
Yeah. So we have, within 24 months, okay, we went from people buying pictures of monkeys through NFTs, cryptos. The worst companies on the planet were going to the moon. They were buying movie theaters that had no business, to now people not wanting to buy anything because we're going into recession. I mean, it's like, I'm not, too religious, but you know what? I pray to God we get this freaking recession already, because the pain of hearing that the recession is coming is so much more painful than probably the recession will be. Okay. My companies that I hold, they are priced for recession, World War I, World War II, bankruptcy, everything. And we haven't even entered the recession, or maybe we did, who knows? But you know what? Why don't we just have this recession that you guys all want to have already, and let's move on, because I'm sick and tired of hearing that we're going to have a recession. Now we're talking about the debt ceiling and this. I mean, it's just non-stop. So, I mean, but that's what the market is. It's just this complete insanity that when the market is happy, like what Warren Buffett said, Mr. Market is happy, he wants to buy pictures of monkeys and pay $1 million for pictures of monkeys. Why? I don't know why. They told me that you should own some monkeys because it's a status symbol. Yeah, NFTs is a status symbol, and everybody should own, because look, this movie star or this pop star has it, so you should buy it. To now not wanting to buy anything because the Fed is going to raise interest rates. I mean, it's just completely crazy. So if I take it to, I always use this example of a house. In 2011, you wanted to buy a house, and the price of a house was $100,000. But the seller says, but you know what? This house has a pool in the back. So then you're like, okay, I'll pay you 110. The seller 5 minutes later says, but we have a pool in the back. 5 minutes later, we have a pool in the back. Then after a while, you're like, hold on a second. Do you want me to pay you $1 million for your house because you told me that it has a pool in the back 50 times? Like, it doesn't work like this. Today, we reverse this scenario, and you're selling the house, and then the buyer says, but it doesn't have a pool in the back. Okay. But it doesn't have a pool in the back. Okay, hold on a second. You already repeated this 10 times. Do you want me to pay you to take my house just because you told me it doesn't have a pool in the back? My house is worth something, whether we are going into recession or not, because it has value. Okay. The same thing with some businesses. They have value irrespective of whether we're going into recession or not. And just because you say it to me 1,000 times, you send me 1,000 videos of why we're going into recession, why it's going to be the worst recession since the Great Depression, doesn't mean the assets that businesses hold are worthless. Just the same way, it didn't mean that the assets and businesses were worth the moon when things were good. But that's what people were doing. During COVID, what were they buying? Amazon, right? Because everybody was going to be buying stuff on Amazon. Zoom, because we were all going to be Zooming, right? We're never going to leave our house. They're all, and Netflix, right? Those are the three stocks that they were buying. And like, you couldn't say, no, you shouldn't buy Zoom. You shouldn't buy Amazon. You shouldn't buy Netflix. It didn't matter what price you were paying. You had to have bought them because we were in COVID and they were going to benefit from it. Well, now COVID is over and those stocks got absolutely decimated because people were not paying attention to what they were paying for things. And now it's completely opposite. They're like, we're going into recession. So they are selling companies that have great futures, great solutions, great problem-solving applications, and they are selling them for pennies on the dollar just because we're going into recession. You see the craziness on the opposite?
Absolutely. There's an insanity of the market going on, that the market overreacts in both directions. And what you're saying is, what we're essentially saying is, and what Warren Buffett also said is, like, when this insanity happens, it actually is a time for opportunity. So in this case, as the market overreacts on the downside, it's actually time to look at those market pieces and potentially buy them. And we're doing this in the multifamily side, for example, because if you look at it, we live in Phoenix, Arizona, and the Phoenix market is consistently getting, the Metro Phoenix area is consistently getting between 50 and 75,000 people moving here every single year. Now, that means that we consistently need, if every family has, let's say, 3 people, consistently need 25,000 units of livable space to be added to our market every single year and every single year. But guess what? Right now, with interest rates up, And with cost of construction high, that has stopped again. At the same time, though, so rents are going up, but because interest rates are up, also a lot of the buyers of real estate are doing exactly what you're saying. They're saying like, but your apartment complex doesn't have a pool, doesn't have a pool, doesn't have a pool. So in other words, they're saying, but the market is soft, the market is soft, the market is soft, and trying to press those prices. So what typically sold at $10 million now sells for 8 or potentially even 7, even though we're in an environment where the demand for apartments is actually higher than it has almost ever been because nobody buys new product. Because I understand the builders are not buying. Now, the builders are not building because it's just too expensive. Right? Now, the cities are getting more and more, they're getting more difficult. Go ahead.
Where did the cap rates go?
Well, traditionally, the cap rate in Phoenix has been, for many, many years, it's been like around 4, which is an aggressive cap rate because it's like for every dollar of income, you pay like $25 for the property. So if property makes $1 million in income, you pay $25 million for it. But now there's property selling at 5.5, almost 6 cap rates here in the market, in an environment where rents are actually, they went down for a little bit, but rents are actually, they can't go down because we're getting 75,000 people a year coming into town, and nobody is building. If you haven't already started your construction, number one, you don't get a construction loan right now. And number two, you paid 8 or 9 or 10% for these construction loans, and the construction costs have not gone down. So it is absolutely 100% predictable that rents are going to go shoot up another year or two from now because the bottleneck is not changing. Add to that the fact that still 44+% of the American population works from home, which means they can actually move, and they're moving from San Francisco, where everything is shutting down. They're moving from the cold countries to markets like Phoenix. So this transition is continues into market like Phoenix, like Tampa, Florida, like Dallas, Texas, like certain markets in the US. And yet you see the exact same thing. And the market does not make any sense. As a matter of fact, buying now makes way more sense if you can hold for like 10 years and wait this out. The market makes much more sense to buy right now. But that's not how the market is not efficient, in other words. And that's the same thing you're saying.
Yeah. And whether it's in real estate or stocks, people want to buy when other people want to buy.
Right.
And they like to quote, be greedy when others are fearful and be fearful when others are greedy. But then they are greedy when others are greedy and fearful when others are fearful. That's what they're doing.
Yeah. They're particularly at the top. It's like I'm missing out on something is kind of the sentiment. Oh my God, I'm missing out. Everyone else is doing so well. Let me get in. And we have a saying in our family. It's like when the mailman starts talking about getting into real estate, it's time to sell your assets. It's time to refinance into long-term thing. It's time to stop buying. And guess what? That's what we're doing. We've been very successful with that strategy. And when all the media says real estate is bad, that's the time to get in. And I think you're probably seeing the exact same thing on the microcap side of things.
Oh, of course.
Yeah. Very cool. Now, this is fascinating. I love this conversation. Now, if somebody wants to do this, do you offer the services that do you have a fund? Do you help people invest in that? Do you teach them how to do that? Or how can somebody learn more from you?
Well, first I would say find my YouTube channel. So take my very hard to pronounce name and type it into YouTube and you'll find my YouTube channel. Yeah. And then I do have I don't run a fund because I can't take people's emotions. But I do have a private membership website called microcapexplosions.com, which is a membership website where I introduce to my members some of my microcap ideas, and then they can choose on their own whether they want to invest in them. But it's their decision. And then a lot of times I bring on the CEOs to do live calls with the members where people can ask them questions and talk about their business. And even sometimes we finance those companies through like private placements, because smaller companies might need money to expand or get more money to reach to profitability, make an acquisition. So, there's an opportunity to even directly invest in those companies. at a discount to what they're trading for. And a lot of times we get a warrant, which is like a right to buy more shares in the future. So there's, benefits like that.
So very cool. That's almost like a multimedia financial newsletter with some recommendations, or at least some highlights of certain things, and then the live components. Very, very, very cool. I like that. So microcapexplosions.com. We're obviously going to put into the links. Very, very cool. So what is your outlook right now for the next for the future? I mean, I know we're going to go into that recession, or we're in it already. I think it's the weirdest recession where
everybody agrees about.
The malls are full, the restaurants are full, people are employed, but we're still in some kind of a recession. And I mean, what I heard the other day, what somebody said, what struck me right, which I think I agree with, is we're really in a recession that is less of a recession, but an asset deflation period. Because the government is still supporting the average person out there with unemployment, with all these different things, but if they're essentially, through the interest rate increases, stop trying to pull liquidity out of the economy to some degree, then what happens is, for over the last 10 years, we've pumped $8 or $10 trillion into the economy. As they're pulling some of that out, the assets are deflating, and the sad, or in this case, perhaps good, truth of the matter is that most people in the United States don't hold large amount of assets. You do, I do. That's why we see some of our asset values coming down. You see some of our asset value coming down, but the average person in this particular case is not tremendously affected by this recession. Do you agree with that assessment?
Yeah, sure. But for me, I don't really care. There's only one thing that I care about, is I'm buying assets. Do I have more or less competition for these assets today? That's it. If everybody is screaming recession, that means they're not buying the assets. So I can buy whatever I want at a cheap price. And anybody that has a job right now that can invest, millionaires will be made by buying things today. Millionaires.
Right, because the market, in your opinion, and I agree with that, has basically, in many areas, not everywhere, you got to be clear about where and where not, and build up a little knowledge, but has overcorrected and gives you the opportunity to pick up very, very solid investments at below market prices right now.
Yeah, well, and okay.
Below fair price. Fair price. Market price is market price.
I mean, pennies on a dollar. Pennies on a dollar in certain situations. But what the market likes to shift in where the market wants to invest. In 2021, the market wanted to invest in risky things and monkeys, pictures of monkeys. Okay.
Yeah.
Then COVID came and everything sold off. And that's when I wrote this book, How to Profit from Coronavirus Recession. And in that book, I featured 50 companies because everything sold off. Everything sold off. And it turned out pretty well when you were brave to invest during the sell-off. Today, the market has a new favorite. Like during COVID, it was Amazon, Netflix, and Zoom. Today, it's the stable, profitable companies. That's where everybody is piling into. Microsoft, Apple's, anything that's stable and profitable, that's where the money is going to. So those companies are now becoming overvalued. So how is that going to turn out? Probably not good. Even though those companies are great, they're now becoming overvalued. Walmart, Apple, all of these names, because they're safe. People feel comfortable. People get confirmation from others. That's where you want to be. And the companies that are considered toxic today are the ones that are not yet profitable, or technology companies. So where do I want to be? I don't want to be where people have comfort, because there's price for comfort. I want to be where people are uncomfortable, because There's price for comfort and then reward for discomfort. But you still want to be in the companies that are going to survive. But that's where they don't want to be today. They don't want to be.
That's the challenge, identifying those. And that's what you have built an expertise, and you recommend those, and that's where you dig in, and that's where the winners are made. That's why it's for so many people so hard to follow somebody like Warren Buffett, because they're not willing to do the work of actually digging into the company and really figuring out, is this something that is going to thrive over time, or is this something that is just a gimmick or is going to go away? And when you develop that skill, then you can do fantastic in those kind of market environments. Great. So with that said, let's wrap it up. So thank you very much for being with us. Again, look Mario up on YouTube, follow him. Right? I watched many of his videos. They're fantastic. I agree with his philosophy. And I wouldn't recommend necessarily you take all your net worth and put it into this, but take a piece of it. Take a piece of it and start looking at those things, because also the skills you develop when you go into fundamental analysis are skills that are going to serve you for the rest of your life in looking at businesses out there. Because at the end of the day, that's like, if you know how to tell a good business from a bad business, that's one of the biggest skills you can have in business. Wouldn't you agree with me?
That's right.
Yeah. So that's that. Thank you for being with us today. And guys, that concludes our show for today. As always, make sure you've enjoyed this. Give us a 5-star review, subscribe, share with your friends. If you're watching this on YouTube, hit that subscribe button, hit that notification bell. And with that said, we are done. See you in the next episode. Thank you very much.